Alright guys, what's going on? Another video. This one's on how I use dealer positioning and gamma flow to find structure inside the market and to see if I'm going to be going with a momentum trade or doing a mean reversion trade, selling at the highs, buying at the lows. So let's just jump into it real quick. So on the left side, we see the gamma exposure chart, market maker exposures by net gamma, and then on the left is the actual position. So what is gamma? Gamma is the risk that these market makers take on when when they open the opposite side of a position, which is our position. So if we're buying a put, the market makers are selling it to us. And if we're selling a put, the market makers are buying it from us. So as price approaches levels where market makers are positions, they're hedging. So when they're hedging, that affects price, and that's ultimately what moves price intraday. So what I like to do is when we come up on option expirations, so if we look here, we have this one of the August expiration, which is on the 15th. These are the highest gamma, and it's usually the week before, which is right coming up now. So what we see is when we see the clusters together, we can see that these levels are going to react in a certain way. So this is a cluster here, and then this would be a cluster here. So when prices approaching these levels, a positive gamma just means that the market makers are going to do their best to dampen the volatility because they're net long. They're long gamma. When price approaches negative gamma, the market makers are net short. They're short gamma. So they're selling options. Now, when price gets to these levels, it often accelerates because market makers are trying to hedge their position. So they need to go with whatever the position, wherever the direction is going. Because if they're net short, that means if they're short calls, they're bearish. If they're short puts, they're bullish. If they're short puts and prices going down, prices going against them. So they don't get more bullish. They don't dollar cost average. They're going to hedge in the short term. So if price is dropping through their put, they're going to short with futures, exacerbating the move. So, and on the opposite with the long game, they're going to try to bring price back towards their strike so that they can have price pin around that area. They don't want price to move far away from it. So if we take this chart on the left, just the one on the right side of the web page, this market maker exposure, and then we can also go and use, sorry about that, we can also go and use the net gamma exposure, which is right here, but we'll get back to that. So as we see these large levels. We can go and plot them on the chart like I did. So what we see here is negative, positive, gamma flip, negative, gamma flip, positive. When price pushes through to this negative gamma zone, it's going to accelerate through it. But once it gets to a gamma flip where exposure goes from negative to positive, price is just going to hit a wall and be dampened. And vice versa, price hits this positive level, doesn't hold, and reaches this negative level, it's going to push right through until it finds its next stronghold, which is this positive level, and then it'll mean revert. So this is how I look at the market when I see the gamma levels. I don't trade them, but say I'm watching price and we're heading down and I look over to my left and I see negative gamma, price, negative, I'm selling with the down move. But if I'm looking over at my chart and we're pushing into highs, and I look over and I see positive gamma, I'm not going to buy into the highs. I'm not going to look for a breakout. I'm actually going to wait for price to move back in and look for a sell. So that's how I use the gamma, and it's very useful. And also, if we go back over here on the left, if we look, let's look up here up at the top, all right? So what we can see is the left side, we have right here, this tells us that the blue is calls and the orange is puts. So if we look up here, we can see that we have a large negative call level. Okay? Now let's think about this. Market makers are short calls at this level. If price starts heading towards this level, what are market makers going to do? If they're short calls, that means that they want price to stay down, right? Because if they're selling calls, it's a bearish move. Now, if price heads up towards their level, then they need to actually buy futures because they're bearish. They have a negative delta. They need to hedge as price breaks through, and this is what is called a gamma squeeze, when price breaks through a level above where there's negative call gamma. So that's what happened to GameStop. That's what happened to AMC. All the hedge funds were short calls, and price pushed through their calls, and they were forced to buy the stock.